Navinder Singh Sarao made $70 million buying and selling futures from his suburban London bedroom before the FBI showed up to arrest him for helping cause a $1 trillion market crash. A preternaturally gifted trader with a penchant for computer games, Sarao was accused by the US government of manipulating markets by posting then cancelling huge volumes of orders to trick other participants about supply and demand. A brand new offense known as spoofing. He believed his actions were justified because the markets were rigged in favor of highly profitable computerized entities known as high-frequency traders or HFT. Many agreed, and in the aftermath of his arrest, Sarao became a kind of folk hero to those of the fringes of the financial ecosystem. The lone traders who took on the billion-dollar behemoth and won. Sarao started his trading career at the rough and ready pop shop above the supermarket. In an extract from his forthcoming book, Flash Cash, Liam Vogel recounts how the man duped the Hound of Hounslow made his first £1 million after crossing paths with another notorious financial figure. After a few years of patiently building up his account, Nav pulled off a trade at the start of 2008 that would catapult him into the big time. The global financial crisis was gathering pace and markets lunged around on news of the precocious state of the economy and the measures of government and central banks were taken to shore up the system. Where the S&P 500 might previously have moved 40 or 50 ticks in a day, it was now not uncommon for the index to jump around in a range of 5%, more than 5 times as much. The turmoil may have been disastrous for the wider economy, but it was a burn for traders like Nav, who thrived on the action. Sentiment had swung firmly from exuberance to panic, and there was easy money to be made. Late one afternoon in early January, Nav was at his desk when he noticed something odd in the DAX, an index that tracks Germany's 30 biggest companies. Despite the swirling negativity, there was a cloud of buy orders waiting in the order book, and whenever the bids were hit, they quickly replenished. The result was that over the course of the evening, while most US and European markets remained depressed, the German index actually crept higher. Somebody out there appeared to have an insatiable appetite for DAX futures in the face of strong signals that prices should be going down. "It's the Chinese, I know it," suggested one trader when Nat asked him what he made of the mysterious buying. Presiding as they did on the fringes of the financial firmament, traders at Futex, the arcade where Nav cut his teeth, were inclined to indulge in conspiracy theories about sinister forces controlling the market. If it wasn't China, it was the Plunk Protection Team or Goldman Sachs or the Bilderberg Group. Whoever was buying up the DAX had significant firepower. For long periods, there were hundreds of millions of dollars worth of bids sitting on the order book. Nav resigned to keep watching the DAX and went home for the night. The following morning, he saw that the index has opened 90 points lower, a substantial drop. Whoever was propping up the market had seemingly given up and gone to bed. Over the few next hours, DAX futures continued to tumble in line with markets around the world. But by late afternoon, the wall of bids had appeared and prices started to edge up again. It was surreal. During the regular trading days for stock, from 9 a.m. to 5:30 p.m. Central Europe time, German futures followed the global downward trend. Then, when the country's stock market closed and volumes tightened up, DAX futures would keep trading until 10 p.m. began edging higher like a salmon swimming against the storm. It wasn't clear who was behind the phenomenon or why. In some ways, it didn't really matter. The important thing was that there was a trend that could potentially be exploited. That night, before heading home, Nav and one of his colleagues devised an experiment. Both of them would sell a few DAX contracts and see what happened. If the market took a tumble as it had the previous night, they would buy back the same amount of contracts the next morning, closing out their position for a profit. If it didn't, they would take the hit and move on with their lives. Generally speaking, it was frowned upon at Futex to leave a position open overnight because you cannot react quickly if the market moves against you. They needn't have worried. The following morning, the DAX opened 65 points lower, earning them more than $10,000 a piece. By day 3, the traders around them had started to take notice. There still hasn't hasn't been anything in the press that might explain the move, but the pattern was clear. Half the office followed their suit, hoping to piggyback on the nightly deviation between the German index and markets around the world. Once again, the markets rallied before collapsing overnight, this time by 80 points. Nav had struck gold. For 2 weeks, he had repeated the overnight trade, placing steadily larger positions before heading home to bed and praying his good fortune would hold. Time and again, it did. And by second week of January, Nav had gone from shorting a handful of contracts to betting 200 lot of night and $15 million position that yielded six-figure profit. As he put everything online, the strength of his conviction never fluctuated. By the middle of January, its balance had ballooned to more than £1 million. On Saturday, January 19, 2008, a 31-year-old French trader stood outside Societe Generale imposing headquarters on the outskirts of Paris and texted his boss, "I don't know if I'm going to come back or throw myself under a train," waiting for him in a conference room inside were the head of the bank's investors banking division and various other executives who have spent the last 24 hours frantically scoring Calvi's trading records after uncovering evidence of what they suspected to be a massive fraud. Over the next several hours, Calvi's confirmed the affairs. Starting in 2005, he confessed he had been secretly placing unauthorized trades worth hundreds of billions of dollars. Unlike most of the firm's elite traders, Calvi, the son of a blacksmith and a hairdresser from Britain, had started his career in an administrative function, and it was there that he learned how to cover his tracks using a combination of fictitious transactions and forgery. He had escaped detention because of the most part he had been successful. In 2007 alone, he said he had made a profit of around $2 billion by correctly predicting the impact of the impending financial crisis. He was never able to claim credit for his success because nobody else knew about it. The story might have ended there, except Calvi had recently embarked on his most ambitious foray yet. Between January 2 and January 18th, the trader had accumulated a long position of $70 billion, doubled the market capitalization of the entire bank. After his colleagues left the trading floor each evening, Calvi had stayed behind, maniacally buying futures tied to the DAX and other indexes, convinced that the worst of the crisis was over and that the market would rebound. But his winning stack had come to an end. Calvi's waves of after-hours buying only ever propped DAX futures up for a few hours every night. Now, like some horrific Wall Street version of Groundhog Day, woke each morning to find gravity had kicked in and the market had sunk back in line with the rest of the world. As Calvi made his confession, Societe Generale's management ordered one of his colleagues to close out his position. By the time the employee was finished, the bank had lost $7.2 billion. News of the incident rocked global markets and helped push the DAX 12% lower in 2 days, wiping hundreds of billions of dollars off the value of Germany's biggest companies. Reading about events at Societe Generale, the traders as footed quickly worked out that Calvi had been the one behind the DAX strange maneuvering. It wasn't the Chinese after all. One of the Europeans' biggest banks had been brought to the brink by a lone trader with oversized ambitions and inadequate oversight. Later, Calvi was sentenced to 3 years in jail and ordered to pay back the entire $7.2 billion he lost, the largest fine ever levied on an individual. His desperate buying spree placed him among history's most notorious rogue traders, a name altered along the likes of Nike Leeson of Baring Banks and Kewelu Adobele of UBS. It also gave a young day trader from Hounslow the capital he needed to take his trading to new heights.